Hello. Well, you know by now that when you're investing, you need to diversify. You can't put all your eggs in one basket, as they say. But Geoff Howie, market strategist from the Singapore Exchange, is here to help us understand a little bit more of how to actually do that. And Geoff, you have a concrete example for us as well today, don't you?
Yeah.
Let's firstly look at diversification among what? I mean, for example, is it enough to buy multiple, let's say, real estate investment trusts? Or should you only buy one stock in different sectors?
Okay, Mark. Well, as we've been covering in our My Gateway seminars throughout the course of the year, we actually examine diversifying the long-term capital gains with risk using different sectors, different stocks that belong to ultimately very different businesses and possibly different business cycles.
So why not just, let's say, diversify among telco stocks and buy some of Singtel, some of StarHub, some of M1?
Well, certainly investors can do that, because when you look at different sectors, obviously within those sectors there's different subsectors and very different businesses. However, if you really wanted to explore the true resources of the exchange and the true, I guess, comparative advantage that we have on SGX in terms of very diversified sectors and considerably liquid and highly capitalised stocks representing those different sectors, then investors should look at exploring the different sector potential that we have.
Right. So in other words, diversifying among stocks, good. Diversifying among sectors, different stocks within very different sectors, better.
It obviously can improve the chances of having diversified risk and returns, and obviously reducing that risk of holding the one underperforming stock.
Right. Okay. Now let's look at some examples that you've brought along with you over here. And so first of all, this is a very busy table, but can you just explain firstly what sectors we're talking about, what stocks are in these sectors?
Sure. As you can see, we are covering three sectors: the consumer services sector, the real estate sector, and the utilities sector.
Right.
The stocks that we've chosen, given this is purely an educative example,
yes,
are the highest market capitalised stocks of those three sectors. So in the case of real estate, we have Hong Kong Land. In the case of consumer services, you can see that we have Jardine Cycle and Carriage.
Right.
And in the case of utilities, we have Hi-Flux.
Hi-Flux, the water treatment people.
That's correct.
Right. So in this first graphic, this I can see here at the top there, it says March 2013, but it also says in the title, unbalanced. In what way is this investment that we've got here on this table unbalanced?
Well, as you can see, what we've done is make the investment in the minimum board lot size. And thus, with Jardine Carriage having that high share price, much of the share portfolio weighting is skewed towards Jardine Cycle and Carriage. And
right. Hence that bar the pie chart at the
exactly.
bottom. That's mostly Jardine, actually.
Exactly.
Because we've bought one board lot of 1,000 shares. Right.
Now, if you're truly willing to diversify over these three sectors, you must ask yourself, are you reducing the risk of having too much exposure, and having too much exposure to the underperforming stock?
So, but what we see here is, so it's probably balanced in terms of the number of shares that you've bought, but the amount of money going into these stocks is very, very different.
Absolutely.
That's the point.
All shares have a different price, and all shares perform differently.
And as a result, that's why we have that overweighting in Jardine Cycle and Carriage. But the bottom line is, and I see that in the title as well, it's still made a gain of 11% over the last 12 months.
Absolutely, and that's just that's not on the fact of having a diversified portfolio so much as that's just what happened over the last 12 months.
But fair to say that if you do just go out and buy 1,000 of this and 1,000 of that, the picture might look very different. Absolutely.
You could that could also be down 11%, obviously, and therefore you would have that effect.
So, for example, I mean, because Jardine Cycle and Carriage is the biggest investment in this sample portfolio, if something had happened to that company specifically, then because of the amount of money that you've got sitting just in that stock, you would be quite badly off. Presumably.
Exactly, because you haven't evenly spread all the eggs in the basket.
Right.
Which too much of the egg in the actual consumer services segment.
That's it. Which brings us to this next graphic, and this is the one ending in March 2012, a year ago. Now this is it says balanced. In what way is this now balanced? Because it's the same three stocks, isn't it?
Yeah, this is balanced by notional value. So you're taking the price of the stock 12 months ago and multiplying that by the number of shares, and therefore basically making up, as you can see, Jardine Cycle and Carriage from the outset will take a large part of the portfolio, and then you make up the equivalent amount in Hi-Flux shares and the equivalent amount in Hong Kong Land. So that you are generally around 33% weighted to each stock and evenly balanced to those three different performing sectors.
Right.
Like the previous example we had in the last quarter with the CS events, where we talked about investing in oil and gas stocks and telecommunication stocks. You basically, if you can revert and look at this chart, which I might just take you back to, where you look at this chart and see all these different sector performances over the last 10 years. And what you're effectively doing is, in this example, we're just choosing three sectors. Now, this is just to do with our quarterly education program, where we focus on these three sectors. There's no subjective reason for choosing these three sectors. Rather, it's just to make use of diversification.
And therefore no recommendation, folks.
Absolutely.
That's the other thing.
No recommendation. This is purely educational, and it's just showing you how these three different sectors have performed differently over the 2-year period.
Right. And then that brings us to our final table, where we've got the same three companies, and if I understand this correctly, it's also allocating it by funds. In other words, a third of your money into each of them. But the performance is very different. Hong Kong Land's actually down in this particular year. What happened here?
Correct. Well, that was the year. This is much of 2011. Mm-hmm. And as you can remember, in 2011, the STI itself was down 17%, thereabouts. So
down 17%?
Back in 2011.
Now,
this period's actually taking into account March 2011 through to March 2012. And during that period of time, I think the STI was down about 3 to 4%, thereabouts.
Right.
So, as you can see, the not taking into account transaction costs, the portfolio returned minus 3%. So it was similar to the benchmark, albeit what you can see is by diversifying, you haven't been overly exposed to one underperforming sector.
Right.
In this case,
the bottom line is: 1, you have to diversify. 2, ideally diversify among sectors and not just stocks within a sector. Because presumably, if something bad happens in the telco sector, then all telcos are going to get impacted, not just the one.
Well, and in some cases, the overall market as well, Mark. You cannot discount the fact that every sector might be down in 1 year. As we're talking about, just in 2011, you only had 2 sectors that actually did perform a return in 2011. As you can see back in this chart. This chart here, you can see in 2011 it was just telecommunications and healthcare, which basically did provide a positive return in 2011. Okay. So I'm just wanted to throw that in, that you cannot
you can't pick winners consistently. I guess
you can't rely on sector diversification to consistently produce the long-term gain. Rather, you're looking at from the point of view of risk, and you're trying to look at the way that you can diversify risk in the most way that will basically mean your portfolio has less chance of having the underperforming stock or the underperforming sector.
I think that's the key word, isn't it? Less chance. It's not about eradicating it, because after all, you'd need a crystal ball to do that.
Yeah.
But the third point, I guess, which I found interesting and perhaps quite new to many people, is this idea that you can't just buy 1,000 of this and 1,000 of that. Real diversification is spreading the amount of money you have among different companies, rather than, in other words, allocating the same amount of money rather than buying the same number of shares.
Absolutely. Good money management, if you will, not just for investors who are looking at whether they're spreading money in fixed income, whether they're spreading their money across various sort of real estate products or stocks themselves, but also within the stocks themselves. Good money management within the different sectors and the different types of stocks as well. Right. And of course, there's an abundance of CS educational resources that can discuss that in further detail.
And they can at Singapore Investment Week. The URL is on your screen now. Meantime, thanks very much, Geoff Howie from the Singapore Exchange.
Pleasure. Thank you.
By the way, what is the most frequently asked question that you get at these seminars? Because you give a lot of these seminars now, right? What are the things that people are still most concerned about or unsure about?
I think it's access to the information.
Really?
Yeah, because most of the time when I finish a presentation, the next day I could have almost 10, 20 emails come through requesting a copy of just the objective information, more information on the sectors, what stocks make up the sectors, how have the sectors performed in the last 10, 12 years. So investors who are wanting to get more informed and have a better understanding of how their stock market has performed in the past. With the proviso, of course, that in all of our education events, we do, of course, highlight that past performances obviously don't add up to
Sure, but at least
results.
it gives some people something to go on.
Absolutely.
And the other thing is this information not readily available already? I would have thought you'd have it on My Gateway.
Look, it is available. It is away, and it is on My Gateway in various educational pieces and resources that we have. Obviously, with FTSE Group controlling the indices, providing the indices, there's only so much information we can provide. But nevertheless, what we are doing throughout this year and possibly into next year is to basically break down all the different sectors that are represented by the 700 or so stocks, and provide some clarity to the investor on which stocks make up which sectors and which stocks possibly are categorised in the sector but don't necessarily have a business that is congruent to the sector.
Right.
So we're in effect finding ways to make the information more accessible and to make the information objectively clear and concise to the investor as well.
Right, right. Good.
I mean, you think that we have almost 800 different stocks on the SGX, and there's over 150 different types of businesses represented in those 800 stocks. So as I said from the outset, we are one of the world's most diversified stock markets. On any given day, the top 10 stocks by turnover, they represent 5 or 6 different stocks. In the FTSE All-Share Index, which basically makes up the universe of stocks of these 12 different sector indices we're covering, there's basically, as we said, 12 different sector indices in there, and 183 companies that basically make up all of these stocks that and sectors.
One other question, though. If the diversification, if the diversified portfolios that you were demonstrating just now are actually quite closely follow the index, then why not just buy the tracker fund for the index?
Well, that's a very good point, and we do have ETFs like the Straits Times ETF index, which basically tracks the performance of the STI of those 30 companies, and then investors can take that long-term performance into the consideration, which I think has basically outperformed real estate prices. If you compare it to the Urban Redevelopment Authority Property Price Index by residential types, which up to March had returned around 6.2% on an annualised basis, versus the STI ETF, which is around the 10% level, not including dividends. So investors can basically trade this ETF like a single stock security. Basically, take the exposure of the 30 stocks, the 14 different sectors, and then if there's a particular sector that investors wish to concentrate more on, they can obviously bring that into their portfolio as well. Such as investors might like to basically purchase ETFs and some telco stocks, or the ETFs and some more higher beta stocks such as oil and gas stocks.
Right.